My name is Lydia Bayud. I'm a reporter at Bloomberg Law. The panel is on fair lending in the world of artificial intelligence, machine learning, and big data, alternative data, also big data. And we've got a great panelist, including our last panelist, Ken Edwards, who's going to join us. But I think everybody here has kind of a diversity of perspectives from the world of industry and consumer protection. So I'm looking forward to kind of having this dialogue with you guys. I think we should maybe level set. So how about each one of you kind of starts off by introducing yourself briefly and say, you know, in the context of your company, what do you mean in talking about alternative data? Why don't you start, Joanne?
Great. Hi, everybody. Joanne Gaskin. I'm a vice president with FICO, or Fair Isaac Corporation. And so many of you might recognize us as an organization that was founded in 1956 by Bill Fair and Earl Isaac. And what we talk about in our history is that, frankly, you know, Fair Isaac or FICO developed behavioral scoring. And the vision for, you know, Bill Fair and Earl Isaac was to take credit data and turn it into analytic models just to make better decisions. And so we are celebrating our 30th anniversary of the FICO score this year. It's kind of great fun. You'll see some announcements out there, 30 years in 30 countries. And I'm going to focus just on what we're doing here in the US to this conversation. But we'd say alternative data to FICO is when we start looking outside of the three main credit bureaus in order to find new analytic information to build models. So you can imagine after 30 years, we've been able to mine most of the analytic value out of the three credit bureau data. And so as an independent analytic provider, we're regularly invited to come in and look at new data sets. And so that's when we take a look using machine learning and AI, what is the predictive value that we can extract from this information, and is it additive to that which we can get from the credit bureaus?
Great. Ken, I'm going to hop around. Why don't you go next?
Hello. Good afternoon. My name is Ken Edwards. I'm Associate General Counsel for Regulatory Affairs at Upstart Network, Inc. Some of you may have heard of Upstart. We have the privilege of being the first recipient of the CFPB's No Action Letter back in 2017 for our innovative use of leveraging alternative data and machine learning technology to underwrite and price unsecured consumer installment loans. I'll put the disclaimer in. Of course, I represent Upstart. I'm speaking for Upstart. But with respect to terms of definition of alternative data, I want to sort of pivot real quick and sort of give my own sort of thoughts on it. I see alternative data in terms of, you know, non-traditional information or untraditional information that's not used by the national consumer reporting agencies to calculate a credit score. And exactly what am I talking about? Sort of you can maybe bifurcate it into the sort of traditional alternative data and maybe untraditional. The traditional is, you know, data, information, data sets that you think of that are non-financial in nature but reflect a revolving debt obligation on a monthly basis or what have you. Think of, you know, rent payments, utility payments, cell phone bills, something like that. And then you sort of have in the other bucket the non-traditional alternative data, and that is data that, you know, in some respects you can say its proximity to, you know, borrower repayment may be tenuous. You know, it may be not too clear. And what am I thinking here? Maybe your, you know, contacts on LinkedIn, or, you know, social media, web browsing history, all of these things that, you know, you may sort of question its validity with verifying whether or not it reflects a borrower's repayment capacity, no matter how high its percentage is in terms of area under the curve. Talking about our earlier presentation. So that's what alternative data sort of means to me. And at Upstart, what do we use in terms of underwriting? Our alternative data reflects educational attainment, occupational attainment, for instance, regional cost of living. All of these alternative metrics that are used in conjunction with the traditional underwriting information like DTI, credit utilization, length of credit history, to really give a much more holistic, personalized view of borrowers, to expand the credit box, but also do a good job of lowering the price of credit.
Why don't we go to Sam next?
Good afternoon, everybody. My name is Sam Tassig. I'm head of global policy for Kabbage. Kabbage is an online small business credit platform. We provide a line of credit to small businesses, typically 3 to 5 employees, between $2,000 and $250,000, and we leverage non-traditional data sets, and I intentionally say non-traditional instead of alternative data, to make a holistic underwriting assessment of that small business and their activities, cash in, cash out, and cash at rest. And I have to say, I think Kenneth did a great job of explaining what my personal view and Kabbage's view is of the non-traditional data world and how AI and ML are playing into that. So I thank you very much. Upstart's a really amazing company, and you know, frankly, I think a lot of folks, including us, look up to y'all.
Thank you.
You know, when we look at the intersection of non-traditional data and the promise of AI and machine learning today, we really do go back to Kabbage's roots, which was founded in automation, data, and technology. We made very conscious decisions early on to move away from document upload or, you know, God forbid, sending in paper documents or using this thing called a fax. And we moved away from that to, number one, encourage customers to, yes, demand automation and digitization from their core financial service providers, but also, and reduce fraud, frankly, but also to create this concept of a holistic underwriting environment. Without leveraging the data that a customer actually creates in day-to-day transactions, we're still relying on more traditional restrictive credit scores, which for a small business are incredibly convoluted because you have an owner-operator and you have the business. And it's insufficient, frankly, I'm sorry to say, insufficient just to rely on a FICO score of the owner, particularly with different sizes and scales and sophisticated levels of an owner-operator. So, you know, we feel that machine learning and the underlying non-traditional data has great promise to provide credit lift to small businesses that are maybe thin file or their owners are thin file. But this is only true when we look at that underlying rich data set. Let's not oversell AI. It's not a panacea and it's not Skynet. It's a mathematical tool, and a mathematical tool is only useful when you have reliable, robust, and in our case, persistently connected mathematical fields, data sets to measure.
Scott.
Good afternoon, everyone. Scott Estrada from Affirm, the Director of Government and Community Affairs. So Affirm is customer experience for installment loans put into an online platform. When I think of alternative data or machine learning in particular, as opposed to more unsupervised learning, it's at the core of what we do through it, whether it's fraud detection, the algorithms, or underwriting. It allows us to have the disruptive effect that we've had in the consumer financial space. But I think that's one part of a broader question of an ethical component of who we are as a company. And given a floor of regulatory compliance and fair lending, what are we doing in the space to actually deliver on our mission of improving people's lives? And I think there is a healthy skepticism of mission statements from the most unscrupulous to the most admired companies. There's usually a mission statement posted somewhere on the wall. So for Affirm, you know, it's more a function of accountability and internal alignment. So when we say customers come first, when we say we want to deliver honest financial services to improve lives, that's not just a post on the wall, it's how we measure internal action. It's how we want to be accountable to our customers in the marketplace within a fair lending context. So, you know, when we talk about that, that's how we align our actions and our mission. So, I hope everyone heard that, because
It was great.
okay.
Okay.
Just pretend it was phenomenal, even if you didn't. So in that sense, when we talk about machine learning, you know, which is dependent upon the past to predict the future by the definition of what it is, that's where the importance of the ethics come in, of having diversity, of having human accountability within the system, of who's getting credit and who's not. So, you know, if we're circling back to talking about what that space of permissive action is, the structure of the marketplace, we've always welcomed those conversations. Our CEO has welcomed collaborative, multi-stakeholder regulation as quite honestly the future of tech, and how we're harnessing all this new technology to deliver on our goals. And that's something that has been well established at Affirm since its inception. So those are conversations we're always open and willing to have, and really see that as the future. So yeah, that's kind of how, when we think about alternative data through an Affirm lens.
Okay, and last but not least, Linda.
Hi, everybody. Linda Jun, Senior Policy Counsel at Americans for Financial Reform. AFR is a coalition of over 200 groups. We were formed right after the financial crisis. Really, we're united around financial reform and consumer protection as a large part of our work. And my portfolio there is our consumer and housing work. So consumer protection and how we best protect consumers in this world as AI and alternative data and machine learning become more of a part of our lives is some of what I spend my time thinking about. And I don't think I have a lot to add to the definition. I think I agree with what people have said up here about what I think about when the words alternative data are mentioned. It's all of the types of information and data points that are considered that aren't part of what goes into traditional reporting at the CRAs. I think as the consumer protection advocate on this panel, I'll say that AI and machine learning both, I see a lot of potential there. Before I came to AFR, I was a legal services attorney doing foreclosure prevention work, and I did a ton of, for example, scanning and emailing my clients' bank statements to opposing counsel, and that's a lot of things now with looking at cash flow and that sort of thing in a more tech way. That's something I welcome, and I had a lot of clients with, not W-2 jobs, right? And I think there's a lot of potential there. On the other hand, a lot of questions I have for these new ideas is when it doesn't work the way it's supposed to, what happens? And when it's humans who are building the models at the end of the day, how are we making sure that, human biases and human mistakes and those types of things aren't just becoming ingrained into the formula in a way that we can't undo or look at or hold accountable and retrace those steps and redo those formulas. And I think about language access, and I think maybe how Google Translate used to be really terrible, and now it's a lot better. And I think that's, for consumers who don't speak English as a first language, that has a lot of potential there. But then I think as a bilingual speaker, I've also seen the translation go wrong, and it's very wrong. So if you just depended on that, what is a disaster that would be? So I just share that to say I think there's a lot of potential with AI and machine learning, but a lot of pitfalls and a lot of concerns, especially as it's developing, that we need to make sure that that regular people, the consumers who are, interacting with these companies and these products on a just a personal basis, aren't the ones who are shouldering the harm or the risks that come with the process.
So I think, as you all know, kind of a very different perspectives on kind of how these inputs are coming into your company. And I thought the lawmakers this morning did a kind of interesting job of framing the thought about how do policymakers approach something like AI and its potential that you all have kind of touched on, but also Congressman Foster this morning said, the issue around explainability of AI is really important for you all in the lending industry. And Scott, your comments on ethics and accountability are interesting. I'm curious, if you guys can talk about how you're going about doing that in a world where you have, not just the data that you all have kind of talked about, but also some more, kind of even more alternative data that Professor Puri highlighted in her research. Not saying that you all are using necessarily, all of that info, but there's a broad world out there. How are you making sure that your clients or your customers are sort of understanding what data of theirs is being used, and being sure that you're kind of in compliance with all the various laws you're subject to? I don't know who wants to go ahead.
I can take the first out of that. I'm going to try to address that because I think there's a few questions in there.
Sure.
I think in terms of the perils and promises of AI, if we look at the most recent study that came out of Berkeley about the mortgage discrimination case about individuals
African American families are getting higher rates based on their geography because they weren't in this model shopping or likely to shop around and were given a higher end. I forget the number of basis points on the front end. Now, while this is a pitfall of machine learning, I'm sure there's an algorithm that determined that, it also shows the efficiency of ECOA and the regulatory structure that we have where you can address those disparities. So I think ECOA, I think Reg B, I think the Fair Lending, Fair Housing Act, especially when it comes to mortgages, is well tuned to incorporate and adjust and evolve with AI. So I don't think there's a completely new regulatory structure that needs to be developed. I think it just needs to be a collaborative, multi-stakeholder approach to how to bring that regulatory structure into the future. And I think I'd be remiss to not just give some of the promises of AI. Is like when you look at non-functioning or broken marketplaces, I look at the payday lending space that we talked about earlier. It's fundamentally antithetical to traditional notions of competition. We have an increase in market participants, but yet there's no decrease in price. I think AI has a promise to deliver on disrupting that dysfunction because it's able to get more credit, more responsible credit, more affordable credit to those that are left, kind of on the margins of a non-functioning market. I mean, if you look at the credit card industry prior to the Card Act, but even after, so it goes to accountability, as Linda said, is that, like Affirm, I'm not going to read down the resume of the mission statement. You can look it up. But when we say that honest financial services, there's no compound interest, a third of our loans are 0% APR. There's a 17% average for the remaining book of over $6 billion of loans funded. I mean, we're having discernible empirical effects where you can see the use of AI to disrupt broken marketplaces. And I think the regulatory structure to ensure that that's done in a fair lending context and compliance is shown when things don't go right, there is accountability. And we've seen that with some of the research that's come out and some of the actions, that we've seen. So bringing it forward and ensuring it's more comprehensive to ensure that the proxies for restricted data points, is robust and rigorous self-testing or self-evaluation under ECOA. I think that the tools are there to ensure the accountability is there.
I agree with you. There seems to be this this desire in many areas in Washington, many topic areas, that if something is slightly imperfect, that we need a holistic, completely brand new law to fix it in one fell swoop. And that's certainly not what we want to do in this world of machine learning, artificial intelligence, and non-traditional data. I fully agree that the statutes today that exist for banks and non-banks, I'm going to talk about a little bit about that in a second, are sufficient to begin to catch the most egregious things, and we should actually begin to apply them with a more modern approach. And I will say that model risk guidance today is somewhat more designed for a more static environment. But I will also say that at Kabbage, we don't really think that AI in the true sense of the definition is pervasive in the financial services industry, at least not in the underwriting perspective. And the difference we see is between machine learning and AI. You may have some true AI in the fraud world where it's an unsupervised model and it is a dynamic, self-creating, self-building model. In the case of credit underwriting world, and I would really challenge anybody to raise their hand and say they're using true AI, they're probably not. They're using machine learning, which is a sometimes dynamic, but rarely truly dynamic, pattern identification tool that is subject to the full bank-grade credit risk committee and model review. Another way to say that is it's a supervised model. So whatever the algorithm, the program might identify as an interesting data set, an interesting pattern, or an interesting series of events, it is reviewed by a data scientist, a credit committee, a legal counsel. And in the case of Kabbage, where a bank is originating the loan and Kabbage is the technology provider and underwriter and the brand, it's going through the bank's guidelines as well and their credit box. So I think there's some confusion about what it actually means to use AI in financial services. Fraud space, whole nother world. That's a little bit more cutting edge, but I don't really think we have the time to dive into that today.
Maybe I chime in a little bit because I really agree with what Sam has just said here, right? From a FICO perspective, you know, one of the places we play is in fraud, and so you may not have been aware of that, but our solution called Falcon is a true AI system that identifies both fraud in credit card transactions and money laundering. And it's a neural network learning system. So if any of you have ever gotten a call or text that said, was that your transaction? That was Falcon running in the background, and so it is used for over 90% of all credit card transactions. It's a scoring system that is learning, that identifies what's the likelihood that that was either you at that location, was it a similar pattern to how you've spent money in the past. But if we take a look back and go into our scoring system and how we think about that, you know, we have over 15,000 clients that rely on us to make certain that we make an FCRA transparent score, right? And the consumers expect it from us and the regulators do. And so that's where we talk about explainable machine learning. And that means that we'll use machine learning to go out and research big data sets to be efficient. But once we have done that, we move back to a traditional scorecard approach, which is then allows us to have human intervention and make certain that we have created what we call palatable reason codes. So the idea is that as a lender, when they're making a decision, could explain to the consumer either why they didn't get the loan or why they didn't get the terms that they were hopeful for in a very clear, explainable manner. And so there's a very strong infrastructure set up within FICO to make certain that we have prioritized what type of data we'll use and how we go about building those reason codes to make certain for palatability. A really quick fun story for you just is that, you know, at FICO you'd expect the analysts to want to do this. They build a machine learning only FICO score, right? They're like, why not? Let's try it. And what we found out is that we could shave over 2/3 of the time off of building a model, right? It's very efficient. But it ends up with spurious correlations that you would never put into the marketplace. My favorite example of this is the consumer who has the largest student loan balance would get a better score. Now, how would you ever explain that to a consumer? But we know if we think about that, the correlation there is that this is an individual that either went to a very expensive school or got a postgraduate degree. And so those are the things that you have to really look out for and why you want to have this intervention by experts when you're trying to go build a model that's going to help make credit decisions.
Could I just jump in here? So in terms of how you explain it, I mean, it's sort of a multi-pronged answer. I would start by saying, generally speaking, an organization, its business practices are dyed the color of its management, meaning that if you have good management at the top, you have a solid ethos, and that is reflected in a solid mission statement, that does go a long way. I mean, you know, if you can think of sort of how we learn, how we go about doing what we are doing, we follow the leadership of a company, and obviously if we can see the mission, that makes it more likely that we can adhere to the mission. What does that practically mean? That means that having management that really cares about what they're doing, their role in the marketplace and benefiting consumers really matters. We have that at Upstart. We have a great, fantastic management team, but practically that means going in and at every stage of that model design, implementation, monitoring, you have management in place that gets together a cross-functional team that actually asks the right questions in terms of sourcing the training data. Do we have the right training data? Is it incomplete? What are we missing? And asking the question, you know, what groups are more likely to get the short end of the stick if something goes wrong with respect to the data that we source, or if this model begins to fail? That's very, very important, because along the way, I mean, these machine learning algorithms, I mean, they're so efficient. The computing power is so powerful. I mean, it's a real concern, because given that their ability to learn from experience like a human being, that runs the risk, if you're not paying attention, of potentially having bias, ethical bias, or disparate impact along protected class lines. So it's very important to ask those questions up front, but also have a very solid model governance framework, right? To ask the questions up front in terms of conceptual soundness, right? Look at the intent and design of the model. Is it doing what it purports to do? or maybe, you know, look at it from a standpoint of ongoing monitoring, doing benchmarking, right? Having a benchmarking model to actually observe the performance of your actual champion model and see if everything is going the way it's supposed to go. I would probably also throw in there in terms of maybe an output analysis, right? And how do you do that? Periodic back testing, right? Checking and making sure your model is performing. There's no deterioration in performance in your model. All these things, again, go back to my initial statement, is with the ethos of the company. You have the right management in place. They understand. They devote and deploy the resources to get all this stuff done. It's not a perfect process. As some of my co-panelists said, we do have a legal and regulatory framework that we have to adhere to in terms of transparency and giving notice, timely notice, and things like that. That's not going away. It needs to be updated and clarified to deal with some of the potential grievances that, you know, we've heard other people talk about that can happen here in the digital space. But for me, it really starts internally with the company, because if you have good business practices inside, it's going to carry out downstream.
Yeah, you know who really cares about management ethos? The credit rating agencies.
Yes.
So if you're securitizing, you are securitizing your model essentially. And when a credit rating agency comes to a company like Kabbage and we give them a different credit philosophy than they're used to, which is disregard the owner-operator credit score essentially and all other attachments to that, and look holistically at the cash flow operation of the business in whatever that means, core bank account transactions, credit card receivables, shipping records, anything that's showing growth, stability, or revenue, that's very confusing to some of the traditional rating agencies. And so they look very carefully at all three things that Kenneth outlined, but especially management ethos, and how that management ethos plays into the actual model governance structure. And we have seen other companies get in a lot of trouble with rating agencies and regulators when there is a lack of accountability between a business team and a model management team and the actual risk operations team. And that, I think, is often overlooked in this conversation. So thank you for bringing that up and walking us through that.
Mm-hmm.
Well, Linda, I want to hear your perspective on this. But first, Kenneth, I think Upstart uses education data as part of its underwriting, right? So, I mean, not asking you to say like why it's great for you guys and not for FICO, but I mean, I think, you know, it might be interesting for folks who are trying to grapple with understanding, you know, why some companies are using that as one form of alternative data when others aren't, and, you know, what is it that Upstart has learned or found in dealing with that type of data that, you know, makes it work for you and kind of within the bounds of the regulations?
No, that is a great question. I mean, I'd say it starts with, again, as I mentioned earlier, it's sort of proximity to repayment ability, right? Meaning that if you pursue an education, you kind of have to stay committed, right? You got classes you have to do, you have a particular, you know, field that you're in and what have you. I mean, getting an education, for all lack of, you know, being specific here, this is a highly educated audience, it essentially shows people that you don't know that you can do something and stick to it, right? And depending on the school you went to, it could be a much more arduous, you know, process or not. Where am I going with all of this? I think, you know, looking at education, assessing someone's creditworthiness, that it sort of feeds into that, right? Because if you're saying like, well, listen, you may not right now have a high FICO score, you may be thin file, you may be credit invisible or FICO impaired, as some people say, but you may have earning potential. You may be in a education program. You may have recently gotten a second degree or what have you. The idea is that can factor into your ability to repay for some of the reasons that I mentioned. And you know, what have we learned from it? I think the proof is sort of in the pudding, right? You can have these alternative metrics. You can look at education, but the real question comes, how do the loans perform, right? That's what you really want to know, right? Because that's where you see where the concern is. And we have a very, very low default rate, half of industry average, to be blunt. And so what that tells us is by looking at this alternative data set, is really what it is, education, is that we're able to incorporate that into our assessment of an applicant's ability to repay a loan on the terms that they're seeking. And it's all borrower provided, of course. You know, that's how we get that information. You go to the Upstart Check Your Rate page. You know, that is one of the questions that you're asked, and you provide that information. You don't have to, but that's what we ask. You provide that information, and it goes into the assessment. And we have seen, some of you may have seen the CFPB's blog post this summer. I mean, how does that practically beat it out since we've gotten a no action letter? Our use of alternative data combined with machine learning technology, we have seen 27% approval rate, higher approval rate compared to a traditional linear credit scoring model. In terms of APR, we see on average 16% lower APR in comparison. So for us, using these variables, to answer your question, what have we learned? We learned that we can expand the credit box, and we can also enhance the pricing of credit, that is, make it lower overall on average.
I mean, I'm going to respond to the education part first, because I think the other question I have with all of what you said, I'm glad that there's a lower default rate, but who's not getting those loans? If you have the same thin file or lower credit score, but you went to community college or you didn't finish that degree, and let's just say that's not because you're not dedicated, but you've had a family emergency. Communities of color, you know, a lot of, if they don't have the access of the resources to get into that school, if they don't know about, you know, there's a lot of people who just don't even know about student loans in the country, like who didn't grow up with that framework, who don't know that information. What if you were the person who you did in fact complete, but it was the for-profit school you went to because that's somehow you fell into that trap because that's the information that was available to you. You know, what kind of credit or lack of credit is being offered to those people? And that's my concern with education, is that's, and using it, is that who is getting shut out of the system or who is getting priced higher because of it. And so that's, and I'm playing devil's advocate, right? Always looking at the other side, because everything that we're talking about up here, especially as it's developed, has two sides to the story, or probably more than two sides, quite honestly, right? As we look at the factors. So that's the type of thing that we're always concerned about. You know, it's, if the things work, and I think there's a lot of good intentions in this space and a lot of potential, and I think a lot of things are working well, you know, but it's always the question of when things go wrong, you know, who is getting shut out, who is paying more, and who is bearing that burden. And I think that's, with education, alarm bells go off for me just when I think of, again, my former clients or people like that. And, you know, how are we accounting for that in addition to the people who are getting the loans? And, you know, using myself, I mean, granted, I have a job, so I'm not a great example, but I went to a private law school. I've been in the public sector my entire career, and if you were going to use what maybe the average law salary is, using education as a proxy of what I make, I would guess that in some formula I would probably not be the picture that you might expect, for example. So I think, again, how good the proxy is, there's a lot of questions there, and so I'll just leave it there.
Could I respond briefly? So in terms of who's getting left out, I think we know. There are a lot of black and brown folk with very low FICO scores who may be thin file, recent immigrants. Those are the folk that are getting left out. But in terms of incorporating this variable, what you're saying goes to sort of weighting and scoring. Nobody's saying is Harvard is better than Howard or what have you, anything like that. It's, you know, what other factors can we consider in addition to your FICO score, assuming it's in the low 600s, to give us a much more holistic picture, a richer set of criteria to evaluate, to determine whether or not you get a loan. Now, that same hypothetical person that you're describing here could easily go apply somewhere else and maybe, for instance, get denied, but for other reasons. The idea is that it's one more factor that's being taken in consideration to provide someone not only an opportunity to get access to credit, but if they get it at a much cheaper cost. But these are all legitimate concerns you're raising, but I want to make sure we don't sort of conflate the actual use of this variable with a sort of end-all be-all approach that if you use it automatically, there's certain groups that are getting the short end of the stick, and that's just not how it works.
I mean, I think there's a lot of, and just responding to that,
Sure.
I think if education is one, and say there's 10 or 15 other things that could go into that box, that changes the conversation, right? Maybe that African American consumer who's looking for something is, they don't have the education, but say if there's other things that the company's looking at that,
Yeah, there
and
is. As
so-
I mentioned, it's like a data
yeah.
set. It's like where you went to school, what degree you got, things like that. What was your major? Things like that. Was this your, bachelor's degree? Was it more advanced degree? It's an entire set of data. Again, the points you're raising are very interesting, but I think it's not quite sort of what we look at through this particular data set to evaluate propensity to repay.
So we're going to leave just a few minutes at the end for Q&A, but Joanne and anyone else who wants to jump in briefly, how are you guys working with AI and ML or alternative data to kind of reach into the non-prime market and reach out to those consumers who might be more creditworthy but kind of aren't able to make it into mainstream financial products?
Yeah, so at FICO we have a financial inclusion initiative underway, and so you can say that the traditional FICO score that people have referenced today serves around 190 million consumers. But that means we're not getting to everybody, right? And so there's roughly 25 million consumers who have absolutely no record at the three main repositories. So we refer to that as the credit invisible population. Largely, it's new to country, minority population, and millennials, which they were talking about earlier today. And so with that in mind, we have tapped into looking at new data sources such as telco data. It looks just like it's regular bill pay data. It's housed by the NCTUE, which is managed by Equifax, so an FCRA compliant. And we're using that for the non-scorable population. It works beautifully for getting that first retail or first bank card. Someone gets experience getting credit, and then they're allowed after 6 months to get a traditional FICO score, and it puts that bridge forward for them. The other, and there was a theme here talking about consumer permission data. I think this is really going to be big in the direction that people are going. FICO rolled out, and we're in pilot. We'll be announcing final results shortly, a score that we refer to as Ultra FICO score. It's an opportunity for consumers to opt in and share information about their checking, savings, account type of data to be complementary to the bureau data. It is, again, opt-in, and we're not looking specifically at how people are spending the money, but it's more about a cash flow analysis, right? And so I don't think that that's very scary to consumers. They're used to providing that as they move in, but it allows us to reach a lot more consumers. So those are things that we're doing to try to help with inclusion.
You're copying us. I'm just kidding.
Oh, no. Well, I didn't correct you about we have an SBSS score
That's
also
okay.
for small business.
Yeah, we're doing it, and I think it's really interesting and ironic that in this big data conversation, there's very little empirical evidence, and I would encourage, I see a couple academics in the room. I think there needs to be more study of this. The FinReg Lab, I think, has done an amazing job at starting this conversation, looking at cash flow data for both commercial and consumer platforms, and looking at credit lift. Separate from FICO and combined with FICO, and the lack of disparate impact, at least in that study that showed up, that's great. That's a great finding, but we need more research like that focuses less on the data inputs and more on the empirical longitudinal credit outcomes.
So we've got about 4 minutes left. I want to see if there are any questions over here. Wait for the blue box. There we go. Good
Cool.
catch.
Randy Moss with one arm, maybe, So this kind of cues in on what Sam was talking about last. Within the alternative data space overall, it seems like there's kind of a gap between the knowledge base of which data points and how they're being used within underwriting and decision making, how they're being used, and there's a gap between what regulators understand, and particularly thinking about Upstart with the no action letter and working with CFPB and how useful I'm sure that's been, what consumers know, and then also sort of what industry knows and what industry is doing. So I'm wondering how the companies that are up here, and really this is open for everybody on the panel as well, how you all are approaching increasing the education related to disclosures, and then truly explaining to people that might be denied, how they're denied, and then, how that functions within your overall model without giving away proprietary information or anything like that, and still keeping your businesses sound?
I'll start off on that one. Again, not to be sort of acute here, but I can't go into too much detail, obviously, but there is we do have a mechanism in place, obviously. And there is no one-size-fits-all to this. Obviously, we know that there are legal and regulatory requirements, again, as I mentioned, regarding transparency, letting consumers know exactly on a timely basis what information, if there is an actual adverse decision, with respect to being denied credit or risk-based pricing under the ECOA and FCRA, you got to let people know. And so we do have a process in place that we do timely let our consumers know, the ones that are denied or the ones that are offered a higher interest rate, what those factors are. So they can, of course, A, know, obviously, goes to the spirit of the statute with transparency, but also B, take any corrective action that they need to if there are any errors, data or information inaccuracies that they need to do. And that comports with the regulations, the commentary. So all that is to say, I can't say much about it, but we are obviously doing that. And again, it's not a one-size-fits-all. This is all very new. I would say that there really needs to be some clarity, obviously, from the regulators in terms of the appropriate use of alternative data, the appropriate incorporation of data sets, even with respect to proxies, right? We all know if there are variables where their predictability is highly correlated with a protected class, like geography, for instance, given this country's historical patterns of discrimination, that could point to protected class membership, but we need clarification on how that's done. I mean, we have vendor management guidance from the banking prudential regulators, but there is no sort of discussion with respect to how they should monitor third parties' usage of alternative data, with respect to credit decisioning. So we need some clarification there. You're raising a good point, but again, there is just there's no one size fits all to this.
Right. That actually looks like we've ended all of. I see Eileen has a question. I want to hear your question. Go ahead.
Thankfully, I don't have to catch this. I apologize if this is a very naive question, but the consumer data that go into the machine learning algorithms, do consumers always affirmatively provide those data to the companies, or are some of the data sets being used unknown to the consumers who are being evaluated?
I'll speak on behalf of Kabbage. Each and every data source, cash flow data source, or other non-traditional data sources explicitly permissioned by the user. We are fortunate in the case of small business that it's a very linear kind of mental reasoning of, oh, my QuickBooks account, that makes sense. We do also work with the bureaus to get some other sort of data, but that's under the standard credit bureau and credit reporting regulations.
I would say similar. So sorry.
No, go ahead.
Similar. I mean, so we are using FCRA compliant data sources that the consumer didn't necessarily furnish, right, themselves. Someone else did under specific guidance, and then they have the opportunity to dispute that information. Some would suggest all that should be permission. That's a whole different topic for us, whole different session, right? But that which we're doing with the one product I said, Ultra FICO, is absolutely consumer permission. It's one-time use. It does not get stored off somewhere to be used again.
Anyone else want to do a quick hit, real briefly? Okay, we're not going to keep you from your cocktails any longer.
Yes.
Thank you for sticking through the panel, and please give us a round of applause.